$6 billion. That's how much Americans borrowed to buy stocks in 1928. But here's what nobody's telling you. That money didn't just vanish when the market crashed in 1929. It destroyed entire families, wiped out generations of wealth, and plunged the world into the Great Depression. And it all started with one simple idea. Let people trade with money they don't have. The system was engineered to make you feel rich while making someone else wealthy. And today, it's bigger, faster, and more dangerous than ever. Let me show you exactly what's really happening. Look, most people think margin trading is some modern Wall Street invention. They're dead wrong. Here's the key. This goes back way further than you think. We're talking about the 1920, when America was riding high on what they called the new era. Stock prices were climbing 20% every single year. Everyone wanted in, but there was a problem. Regular people didn't have enough cash to buy stocks. So brokers came up with a brilliant solution, or so they thought. They said, hey, you only need to put down 10%. We'll lend you the other 90%. Think about that for a second. 10% down. You could control $1,000 worth of stock with just $100 in your pocket. It felt like magic. It felt like free money. Let me show you what really happened. National City Bank, led by a guy named Charles Mitchell, the press called him the ideal modern banking executive, turned banks from frightening places into department stores. They opened 69 branches across 58 cities. They advertised everywhere. They sent salesmen into churches and train stations to drum up customers. Here's what nobody tells you. Mitchell and his banking buddies weren't just offering loans. They were creating demand. They were manufacturing desire. They convinced housewives to speculate with grocery money, bookkeepers to gamble with company funds, regular people to bet everything on the promise of getting rich quick. By 1928, $6 billion was invested on margin. $6 billion. Up from just $1 billion at the start of the decade. The Federal Reserve saw the warning signs and tried to stop it. They raised interest rates in March 1929. The market wobbled. But Mitchell, he announced Citibank would pump $25 million into the borrowing market to keep the party going. And it worked. For a while. Here's the thing people don't understand about margin trading. When prices go up, you're a genius. When they go down, you're bankrupt. There's no middle ground. September 1929, the market peaked at 381 points on the Dow. Warning signs were everywhere. Industrial production was slowing down. Wheat prices collapsed. Farmers were failing. But investors, they kept borrowing. They kept buying. Then October 24th happened. Black Thursday, 13 million shares traded that day. The average was 4 million. People panicked. The ticker tape couldn't keep up. It fell 3 hours behind. Investors had no idea how much they were losing, but they knew it was catastrophic. Here's what nobody tells you. When you buy on margin and prices drop, the broker sends you a margin call. That means you need to add more cash immediately, or they'll sell your stocks to cover the loan. When millions of margin calls hit at once, everyone was forced to sell. And when everyone's selling and nobody's buying, prices collapse. It becomes a death spiral. Black Tuesday, October 29th. 16 million shares traded. The Dow dropped another 12%. Utility stocks, the hot investment everyone was betting on, fell 55% in just 2 months. People who borrowed 90% to buy stocks, they didn't just lose their investment. They lost everything and still owed money to the brokers with interest. Let me show you the scale of this disaster. By 1932, the market had lost 89% of its value. A dollar invested at the peak was worth barely more than a dime. Banks failed, businesses collapsed. A third of Americans lost their jobs and life savings. And here's the twisted part. Some people got rich. Guys like Joseph Kennedy shorted the market and made millions betting against everyone else's dreams. Now, forex trading, that's a different beast entirely. But it follows the same pattern of evolution, and understanding where it came from shows you why it operates the way it does today. Here's the key. Currency trading is ancient. The Babylonians were doing it 6,000 years ago with the barter system. But organized foreign exchange? That started in Amsterdam roughly 500 years ago. Merchants trading across borders needed to convert currencies, so money changers set up shop. Fast forward to the 1870s, the gold standard gets implemented. Countries could only print as much currency as they had gold reserves. This created stability because exchange rates were fixed to gold. But here's what nobody tells you. After World War I, countries needed to print massive amounts of money to pay for reconstruction. The gold standard collapsed because it was too rigid. Nations couldn't expand their money supply when they desperately needed to. Then came Bretton Woods in 1944. Picture this, World War II is ending. 44 allied nations meet in New Hampshire to redesign the global financial system. The United States was the only major country not destroyed by the war. They had the gold. They had the power. So they created a system where every major currency was pegged to the US dollar. And the dollar? Backed by gold. $35 per ounce. Fixed, stable, controlled. Let me show you why this matters. For nearly 30 years, currency values were basically locked in place. No speculation, no wild swings, just stable, predictable exchange rates managed by central banks. But in 1971, everything changed. Richard Nixon, and this is crucial, he made one decision that transformed global finance forever. He announced the US would no longer convert dollars to gold. The system collapsed overnight. Here's what really happened. The dollar devalued multiple times. In 1973, at the Jamaica Conference, major currencies switched to floating exchange rates determined by market forces, not government pegs. And that's when modern forex trading was born. That's when speculation entered the currency markets on a massive scale. Now here's where it gets really interesting, because the systems we're living with today are direct descendants of these moments, and they're designed in ways most people don't understand. The forex market today, $9.6 trillion traded daily. 9.6 trillion. It's the largest financial market in the world. And here's the thing, it runs 24 hours a day, 5 days a week, across every time zone. In the 1990s, the internet changed everything. Online brokers gave retail traders access to markets that used to be exclusive to banks and massive institutions. Suddenly, someone sitting at home could trade currencies on their phone. Here's what nobody tells you. The leverage in forex markets is insane. In the US, you can trade with 50-to-1 leverage. In Europe, before regulations tightened, it was 400-to-1. That means you could control $40,000 with just $100. Sound familiar? It's the same game as 1929 margin trading, just dressed up in new technology. And margin trading in stocks? After the crash, the Federal Reserve implemented Regulation T in 1934 as part of the Securities Exchange Act. Now you can only borrow up to 50%. Seems safer, right? Let me show you the reality. 50% leverage still means if your stock drops 20%, you've lost 40% of your money. A 40% drop, you're wiped out. Game over. In 2008, we saw it happen again. The housing market collapsed. Credit dried up. Lehman Brothers failed. The entire global financial system nearly imploded because institutions were over-leveraged and trading with borrowed money they couldn't pay back. So why was all this created in the first place? That's the question everyone should be asking. Because the official story and the real story are very different things. Here's the key. The stated purpose of margin trading was to increase liquidity and allow more people to participate in markets, give investors more buying power, amplify returns, democratize investing. Sounds noble, right? But let's talk about what it actually does. Margin trading serves 3 real functions. First, it generates massive profits for brokers. They lend you money and charge interest daily. Whether you win or lose, they collect. Second, it inflates market volumes and creates the illusion of activity and growth. Third, it allows institutions to control enormous positions with relatively little capital. Let me show you who really benefits. When markets go up, everyone celebrates. But when they crash, regular people lose everything, while brokers get their money back first. The borrowed capital gets recovered before you see a penny. The system is designed to protect the lender, not the borrower. Forex trading? Same deal. The purpose was to facilitate international trade and allow companies to hedge currency risk. If you're a business importing goods from Japan, you need to convert dollars to yen. Forex markets make that possible. But here's what nobody tells you. More than 90% of Forex trading today has nothing to do with actual commerce. It's pure speculation. Traders betting on whether the euro will rise or fall against the dollar. Algorithms executing millions of trades per second. The leverage. the 24-hour access, the massive liquidity. It's all designed to keep you trading, keep you in the game, keep you believing the next trade will be the winner. And margin requirements, those exist to protect brokers from risk, not to protect you. When they sense danger, they issue margin calls and force you to sell at the worst possible time. Your loss is their protection. Here's the truth they don't want you to understand. Both margin trading and forex trading were created to solve legitimate problems. Margin increased market participation. Forex enabled global trade. On paper, they're useful financial tools, but they evolved into something else entirely. They became weapons of mass financial destruction, dressed up as opportunities. Here's what really matters. The 1929 crash didn't just happen. It was engineered by a system that encouraged people to borrow money they couldn't afford to lose and bet on prices that couldn't sustainably rise forever. The system rewarded reckless behavior until it all collapsed. Let me show you the pattern that keeps repeating. Every major financial crisis follows the same formula. Easy credit, rising prices, euphoria, leverage stacked on top of leverage. Then one trigger, wheat prices, housing market, utility regulation, and the whole house of cards collapses. We saw it in 1929, we saw it in 2008, and we'll see it again because the fundamental structure hasn't changed. The tools are more sophisticated, the markets are faster, the numbers are bigger, but the mechanics, exactly the same. 80% of beginners using margin trading lose their invested capital. 80%. That's not bad luck. That's not lack of skill. That's the system working exactly as designed. So who created margin trading and forex trading? The answer is more complicated than a single person or date. Margin trading evolved from the loose credit practices of 1920 America, pushed by bankers like Charles Mitchell, who saw profit in lending to speculators. It was formalized and regulated after the disaster it caused. Forex trading has roots stretching back millennia, but modern forex, the speculative, leveraged, 24-hour global market that was born in 1971 when Nixon killed the gold standard and freed currencies to float. Here's what you need to remember. These systems weren't created by accident. They were designed, refined, optimized. And the optimization wasn't for your benefit. The house always wins because the house wrote the rules. And until you understand that the game is rigged at a fundamental level, not through conspiracy, but through mathematical structure, you'll keep playing it and losing. They don't teach you this in school. Financial advisors won't explain it. Brokers definitely won't mention it. Because if everyone understood how the system really works, they'd stop participating. And that's exactly why this information had to come out.